Is there a risk of being too concentrated in U.S. equities when so many of the rest of the world's markets seem undervalued?
The quick answer is my work on passive actually suggests that the best thing to do is simply participate as this nonsense occurs. But basically, it's a little bit like the party that you want to be kind of close to the door because you see the rowdy fraternity guys getting a little too drunk, right? The rest of the world, the rest of the world's markets, I would argue, are actually not particularly cheap. There are exceptions to that. Places like China appear very, very cheap on a fundamental basis. But I would also suggest that they run a very high risk of exactly what we saw in Russia, which is they become a persona non grata in the United States. We forget that the same things happened at the start of the 90s. Really, what kicked off the crash of 1929 and the Great Depression was not actually the crash of the stock market. Only 10% of the US population was invested in the US stock market. It was the loss of collateral for businesses and debt holders in places like Germany when Germany chose to default on their debt. Same thing happened in Russia, et cetera.